Scott, you know what I love about our show more than anything?
No.
We focus on the things that matter, right? We talk about the markets, we talk about the economy. We don't talk about like sports or anything like that. Doesn't really matter like that kind of stupid stuff. We really talk about what matters.
Right. Taylor Swift, Justin Bieber, WrestleMania.
Yeah.
Things that matter.
Right.
I think. I mean, you say we don't talk about those things. Those are actually the things that matter to me as a 47-year-old man that's probably a child.
But we never talk about football.
No, we never do. Except you do sometimes. I mean, I think Bears fans just in general talk about football like they actually have a chance every season. And I hate to say it, but every season it comes up negative.
Was there a Bears
zero.
game? Should we just talk about the Fed?
Yeah, go to the Fed because otherwise people are going to see what you're wearing and wonder why you're wearing such a nice outfit.
Yeah.
Which is what?
This is a Adrian Peterson Vikings jersey.
Adrian Peterson.
Unfortunately, last night the Bears just an all-time meltdown. Can we start?
Typical.
Please? Can I just do like a minute of Chicago sports radio real quick and then we get going?
If anybody can stand it, sure.
Okay. Give me 60 seconds, guys. I'm worried. Caleb looked bad. Caleb can't see receivers downfield. He's very quick to run, which is great. I'm worried about the coaching. Ben Johnson, a lot of questionable decisions. It looked like didn't really understand how to direct an offense for Caleb. It looked like, we had the timeout at the end of the game. We had at the end of the game when you're kicking off, when you need to conserve the 2-minute warning, we kicked off with a kicker that clearly can't get it through the end zone instead of onsiding or maybe kicking it straight out of bounds. I don't know, doing anything else. I'm worried. I'm very worried. I think Cairo Santos needs to start learning Canadian because he should be playing in the Canadian Football League, not the NFL. And I think this team is destined for another 3-14, maybe 4-13 season. I think Tyson Bagent comes in probably midway through the season, and we're restarting the clock again. Let's tank for Arch Manning in 27.
I agree. I think a new quarterback is probably basically going to be the elixir. I don't think it's Ben Johnson that much. I mean, Ben Johnson.
He doesn't look like a head coach.
Yeah, but it's one game, and he's been a coordinator for many, many years. He's been good at it. I think he ran actually a decent setup for Williams. I think Williams just stinks. The running game wasn't there either. I mean, Swift wasn't exactly great, and I think also you have issues with the fact that like the Vikings started changing their game plan. I think during like say the third quarter, and certainly at halftime, and they didn't react because they didn't expect it, which is odd. That's a coaching mistake. And Cairo Santos, like he stinks. Like he can't kick the ball in the end zone, which he should have done, and kicked it out of the end zone, and he missed that field goal. That was the worst slice I've seen on like a 30-yard shot since you hit that golf shot about a week and a half ago at Olympia Fields.
Yeah, that was
that basically cost us the Euro Cup.
That was right. That was tough. How'd you think the Vikings looked? Your Vikings.
Jekyll and Hyde. Typical Vikings, though. They show up. They look. There's a lot of hype. I do love J.J. McCarthy. I've said that for a long time. You've got a Adrian Peterson jersey on, which is one of the guys that changed my life basically as a football player. And so like now that we have a guy like Justin Jefferson, even Aaron Jones looks pretty good, and the defense looks decent. So the Vikings though don't have the nucleus yet. I mean, J.J. McCarthy is the kind of guy, unlike Caleb, that you build around. But this team still has a lot of weird moving parts. And Kevin O'Connell's an awesome coach. The coaching is great. Brian Flores is awesome. The special teams look pretty good. But I've been there too with the Vikings, man. I've been there where it seems to be very hypey, very excitable. You take your mind, kind of like investing, and you take your mind and take it to places where like, oh my God, if I buy this stock here, it's going to be so good. Oh my God, if I just sell it in Nvidia and buy something else, it's going to be so good. You go to those places with, I think, NFL teams these days, especially with all the hype that's out there. And the reality is there's usually, like in the stock market, and the stuff we talk about with the indexes we invest in, the stocks, Jake, it's like there's really just a handful of like 3 or 4 good teams and good stocks out there that kind of ride with you the whole time. And otherwise, you got to just mix and match all these parts, just like I think the Vikings are going to need to do most of this year.
So before we go around the league and kind of give some week 1 takeaways, I want to call back to a couple episodes ago when we were talking about the consolidation of streaming services, ESPN buying Red Zone, what kind of the stepping stone ladder would be for ESPN to ruin Red Zone. They don't even have Red Zone this year, and we see commercials on Red Zone. I know you're not a big Red Zone guy. I think you're like a 1 game at a time guy, or maybe not even
half a game.
So Red Zone started with 4 15-second commercials. Completely innocent. Feels like nothing changed, right? They just went side by side on the screen for 15 seconds 4 times. This is literally just the start. Next year, we're going to have full 5-minute commercials. Scott Hansen can't even say commercial-free football anymore. It just feels a little bit tainted already.
I mean, it feels tainted fully. I mean, I think it's going to get worse, and I think that's what you've seen with ESPN and some of the stuff they've done with ABC and Disney and all that stuff, just that whole conglomerate stuff with Time Warner, with CBS. It changes the whole facet of the game, and it gets less players in there. It gets more of a corporate environment. It gets more of a traditional media type of environment that needs money, by the way, because if you didn't notice, they spent quite a bit of money for Red Zone last time I checked. I mean, it's pretty hefty dollar, and I think that's something that is a good investment, provided that they manage to grab everybody in there and push them into this ball and say, you're going to watch these commercials whether you like it or not, and you're going to have to watch the Bears lose more games throughout the year because they stink. And it's like, that's a horrible thing to do to people, but it's something that they need to take a dose of reality with, because of the fact, as we do these conglomeration things, everybody talks about streaming and how expensive it got. It's like, yeah, it did, but also that was nice because you could pick and choose different providers. Now all these providers are squishing together again, with Bob Iger and all those guys talking about on TV, Disney chairman, about how great the streaming consolidation is. No, it's not, because now they're getting all this pricing power back, and you don't have the choices amongst all these different providers, and you got to stick with one or two of them if you can freaking afford it.
Yep.
That's it.
No, I mean, it's 100% right, and I'm worried. I'm just worried.
Sounds like you're worried.
I'm worried. My biggest takeaway from week one, I think, on the surprises at least, you're going to see my tone is completely directed by the Bears, but I thought Rodgers and the Steelers, I did not expect the offense to look that good that quickly. We'll see if it's just a kind of week one against the Jets, he hates everybody in the organization sort of thing, or if there's something there. And then the team you called out when we did our NFL preview about a month ago, I thought the Jags looked really good. We'll also see if that's a Panthers thing, but I thought Trevor Lawrence and Liam Cohen looked real good calling the game together.
T-Log looked good. I mean, I'd say
what did you like on Sunday?
I liked kind of what I liked a little bit of what the Broncos did. It was a weird game, and the Titans stink.
It was a weird situation.
Yeah, it was a weird situation. I think this. I'm surprised the Falcons played as well as they did. I thought they'd be a stinker.
They lost.
Yeah, they did, but they played better though than I thought they would though. I thought they'd get blown out by the Bucs. I think Washington's still a team to reckon with. I mean, I think Giants came out as really flat. Patriots came out pretty flat too.
Yep.
The Bengals and the Browns was a weird matchup. I mean, the Browns have a similar kicker as Cairo Santos. Maybe they could do a little onesie-twosie and slip him around.
That guy's actually worse than Cairo.
Barely. I mean, barely, dude. Give Cairo another week. But it's one of those things where it's like the NFL, though, to me, Jake, vis-a-vis the college football scene, it's just a little bit more interesting again, because at least you have guys that you kind of know where they are.
Yeah.
I mean, you watched that Oklahoma-Michigan game last Saturday night. I don't know who the heck's on Michigan other than that Underwood quarterback, who's awesome, by the way. Yeah, $1 million man plus. And it's like, that guy's fun to watch. And, watch the Michigan State game, too, a little bit. And, like, just the Big Ten stuff was fun to watch. But it wasn't quite as, like, excitable, like you said, as, like, I mean, almost, like, pooped my pants, if I could say that, when you brought up, I just did, because you brought up Aaron Rodgers. It's like, damn, we're still talking about Aaron Rodgers. And now the guy's wearing silver or golden black. It's like, damn, he's on the Steelers now, playing against the Jets, his former team, where Justin Fields was on that team. And, oh, by the way, that game was like that game scored over 50 points, and the Steelers won the game with like a 60-yard field goal in the Meadowlands,
right,
at MetLife Stadium. Like, how awesome was that?
Every other kicker in the league drilling 55-plus yard field goals.
To win the game for a 60-yarder on the road, like, pretty good, man. Chris
so
Boswell, how are you?
Real quick, let's do some overreactions. Anybody you see across the league that is just should be in panic mode?
I think you got to look at a Patriots team. Miami's basically in panic mode. I mean, that's another AFC East team. I think the Ravens actually losing that game as they did against the Bills. I mean, major screw up. That's a big one. And I think the Bears should be in panic mode too. Surprisingly,
I'm with you. I think the Bears. I think the Lions. They'll probably get right next week against the Bears, but. Boy, that looked pretty, to use a word, discombobulated without Ben Johnson running that offense. I mean, they had nothing. Could be a factor of the Packers, who I think had the most complete game on Sunday out of any team in the league.
They looked great.
Offense and defense. That's the real deal right there.
That was a good setup.
The team to beat.
Yeah, and I'm surprised you even used the word discombobulated. I didn't even know what that meant until you said it. And it's like, I think that's good. I think the Broncos, like I said, struggled a little bit, but they looked okay. And then I think you got to look at like those teams that are just kind of always there. I mean, the Chiefs looked like kind of weird on Thursday night, but then
Herbert looked awesome.
Herbert looks great. So like the Chargers are making a move there, and I think too, like the fact that the AFC East is probably just going to be an absolute just rug for the Bills to just run all over. So that's one. And then also, like you said, I think there's going to also be a team in that South to West division of the NFC, which I still think is going to be the Cardinals, coming out there and surprising folks with your boy Kyler Murray, your boy Marvin Harrison Jr. So there you go.
All right, that's good.
Thank you.
You like the Cardinals all offseason. I didn't really see it. I still maybe don't see it.
Then don't.
So we got a pretty, I'm not going to say shocking job revision and job number on last Friday for August, July, June. But if I could recap what happened, we had August jobs that came in under expectations, 22,000 new jobs, short of 80,000 expected. July was revised up about 7,000, kind of a nothing burger there. June, though, revised down, was already down to like 13,000 new created jobs, revised down to actually be the first negative month since 2020. So we've got the first negative month since 2020 in terms of jobs created. We now had the worst 2-month revision in the last 60 years. And then today is Tuesday, so as of about an hour ago, we got the news that payroll jobs over the last 12 months ending in March were revised down 911,000, which was way above expectations of like 750,000.
So that's Biden and Trump together. That's
100%.
kind of a combined effort, guys.
100%. That is
Democrats and Republicans
the
working
economy.
together,
That's
smashing the economy.
So,
it's great.
I mean, this goes back to the topic that's at the front of every conversation. The economy is weakening to weak, right? We talked about strong to quite strong about something last episode. The economy is weak to quite weak right now. Do you share the same sentiment?
I don't. I think the headline numbers, it depends what the headline numbers you look at. I mean, you want to look at CPI, which is starting to perk up again because there's demand, there's tariff issues and such. There's no supply issues, frankly. I mean, this stuff is just expensive. So there's some price inflation. Yeah, job numbers don't look great because the tariffs are impacting that because business is probably overhired for a while. And then now they're kind of like looking at Trump's administration and be like, well, we don't want to necessarily run out and hire people that are questionable because you may get arrested and just get the company shut down in a second now. But also the fact, too, that like look at GDP numbers. We're going to have GDP probably, and based on our internal research, boys and girls, it's like we're probably going to have GDP pushing over 3% for the second half of the year. So you've got a 3% GDP rate, which is, frankly, of the developed countries in the world, the highest, one of the highest rates in the world, the highest sustainable rates that we've had now for a couple quarters, along with inflation that's still kind of at 3%. You got a 10-year note that's pushing 4%. Yeah. Well, no, it depends on the CPI. If you ex food and energy and thing, I'm just saying, like, there's a lot of data points within that mushing and mashing, Jake, that you just did to me, where it's like you can take out numbers that show that there's still that kind of like growthy kind of backdrop to, yes, it's not a crazy everybody wins a trophy type of thing like you got in 5th grade. It's like there's a thing where you actually have to make products. You actually have to go to work. You actually have to like show up. So sure, the economy's changed a little bit because we don't give out money a hand over our fist like we used to some years ago. But it's also one of those things where there's opportunity out there, and I think that's what the economy's telling you, and why I don't think we should still cut rates. I'm just saying, I'm silly.
You're going to have to, at some point, and it's going to be in the next like 5 minutes here, just accept that they're cutting next week, and then we'll move on to October and December.
They'll cut and then they'll hike.
They won't. But, I mean, first, you've got unemployment that I know we're talking a lot about labor, and you focus on other numbers like GDP and inflation, which is a total picture. I agree. But unemployment's up again to 4.3%. I mean, you have unemployment exceeding open jobs.
It's so high.
First time
oh
since
my God.
2021.
I'm so
it's not
scared.
high, but it's higher than open jobs since 21, which leads me to a conclusion of what the last few years have been. So you've had more open jobs than unemployment. Are companies just not hiring? Are the people that are looking for jobs not looking for the jobs that are open? Is this a kind of ICE sort of immigration issue where the jobs that are open are not wanted by citizens? I mean, what is going on?
Yeah, it's all of it.
Is it a no hiring economy?
It's all of it. It's economy, to your point, that is phasing into the next role, which is, I think, that whole AI side of things. I think it's more of an automation. It's kind of that weird spot we're in where we're staying
Your job will probably be replaced in like a year.
Mine?
Yeah.
It's already been replaced.
I'll be talking to a computer. I'll be talking to Ezra next.
You better be lucky you're talking to a computer, because this computer's is destroying you actually so far today, and even in the games, in the picking of the games. I mean, you can just go to the tape on that. But the issue too is the economy is one where, Jake, we're doing these kind of phasing in, phasing out of certain things. The hiring point you made a good straying down. How about the fact that some people are staying home from work, some people aren't, and then the folks who are like, yeah, you know what, we said you can stay home from work for a couple days a week, no problem. They're like, hey, by the way, if you're not back in the office in the next like 60 days every day, you're fired. And then also they do list jobs. You're right, man, that are listed on LinkedIn, on Indeed, and all that stuff that the companies don't intend to hire, and they're just putting them out there so there's some sort of like visibility and all that thing, and they don't, unless they get this absolutely perfect candidate who, to your point as well, is correct. I mean, it's almost like you're looking for another job or something, frankly, because you knew a lot about the job market there from like an experiential standpoint. It's like these guys come out there and they're not looking for the right job, or they want to go into a job listing or a posting or something, where it's like they come in and they want to talk about this or that, and all of a sudden they just pivot and the person's not ready for it and they don't get the job. So there's a lot of miscommunication there between companies and employees, and I think that's one of the workouts here. It's your thing you said earlier, which is like, is this a Fed problem? Like, is the Fed problem going to be the economy, where it's all of a sudden like the economy's not creating jobs, so that's why they need to cut rates? I don't think so. Fed should be on inflation only, and we should get the environment out of D.C. better for the corporations as far as they want to hire or not.
Yeah, it's an interesting point because the Fed focuses on their dual mandate. They always talk about it, and it seems like they're putting the labor market ahead of
and that mandate is
full employment and low inflation.
Right, and price stability, right, or low inflation. In their case, low inflation. So it's like, okay, inflation's relatively low, but like not low enough to where I'd say like we hit that T-shirt level at 2%.
Right. Not even close.
Right, not even close. Actually, truly,
it's not even close.
I mean, based on the stuff you buy, it's like your inflation rate's like at 16%. I don't mean the credit card delinquency rates, but it's like there's also another spot.
I spent $70 at Egg Harbor for breakfast the other
That's
morning.
pathetic. I thought it was be 130.
That was insane.
So it's like there's also another issue where like you have that situation where the Fed is getting that kind of price stability, or did, and then we're going to cut rates to unstabilize that. And then two, like what is maximum employment these days? Like we've got a lot of automation. We've got a lot of people around here that, again, you made the point. They don't want to work, or they're not looking for the right jobs, or whatever the deal is. I mean, we bring guys and gals into our firm all the time from referrals, from job offerings and things like that. And some of the folks are great. They're amazing. Like I want to hire them tomorrow, you know. And we got one here today in the studio with us too, hanging out. It's like we also have folks that come in and don't have any preparation for it, or don't really even want the job. It feels like, or they feel like they're going to be here for like 10 days and be like, see ya. Am I going to get my retirement benefits? And it's kind of like there's a whole misunderstanding of things where that needs to be worked out too. Besides what the Fed economic, kind of entanglement is these days.
Okay, so a week from today. It's not if anymore, it's when. The Fed will cut. We'll see if it's 25 or a jumbo cut. It'll probably be 25. What do you think happens in October and December? I mean, put on your thinking cap. I know you don't want them to cut, but I said this on our first episode, I think. I see a series of cuts to end the year. Whether it's 2 or 3, I don't know, but I see at least 50 bips lower.
I do too. I think if they start here, they don't stop, frankly. I mean, it's just like what they did last year. They start, they don't stop. I'm not going to say they're starting yet, Jake. And you make fun of my thinking cap, which is like my toupee, but I think my toupee and me both believe that if they start going, they're going to stay on that track. They're not just going to cut once and stop. Fed funds will be like, oh, yeah, we're done. That's just a little booster. I mean, it's going to take 18 months to get that thing in the economy anyways, we've seen from the last cuts. Yep. So it's going to be this will be 3 cuts probably into the end of the year, and you may win that. And maybe you actually get to wear something fun on the podcast once and for all. Make me wear something like a Santa suit or something from, I don't know, something from maybe the New Year's party you've been at last couple of years.
Yeah, maybe. I think what's interesting is the market reaction to the poor economic data that we've had. And so you can see we had the economic data on Friday with jobs, very underwhelming. We revised down like we just covered, but the market was up. The market was up. The market was even on Monday. The market, even today, Tuesday, when we got this negative payroll number, is flat still. I mean, it moved down a little, but it's still flat. That tells me, Scott, that the market is obviously this is poor data that we're digesting, but it's going to lead the Fed to a cut, and the market really wants the Fed to cut. Even rates are down again today. So rates down, market up. That means everybody, bond and equities, are happy with a cut coming.
It's so manipulated. I liked how the mic tried to attack you there. See it try to like hit you in the throat?
I did.
That was awesome. Next time, get him. I think there's also like the thing about like the market's up then. So like, why do we need to cut rates, man? I mean, this is like the whole thing. It's like the economy's so good, supposedly, according to Trump, a month ago, and then it wasn't, blah, blah, blah. And it is, depending on the time of year, time of day, whatever. It's like, okay, it's good, it's bad. It's like there's the market's doing fine. And yesterday, too, all-time high on the NASDAQ. Amongst nothing. Like we got through all these earnings that were decent. We talked about Nvidia, we talked about Microsoft, we talked about Meta, stuff we own over the years. It's like those things have done great, and they didn't have really much of a reaction. In fact, a couple of them got sold down. I mean, Google had some good news the other day about litigation.
Chrome.
But it's like other than that, there really hasn't been much other than just kind of like this gentle meandering, which to me tells me you're right. The setup is such for a rate cut, and if we don't get one, that's probably bad for the markets. But remember what I told you, ladies and gentlemen, is anytime you get a pullback in the market, that's actually a gift. It's when the market keeps going up and going crazy and getting on the headlines. Everything's so great. This Fed cut's coming. This is going to be really awesome. My mom calls me and wants another share of Nvidia in her portfolio when she shouldn't have any to begin with. And it's like, that's usually the sign you got to run away and run away fast, just like we're kind of running away from the Bears team this morning.
I mean, I'll answer your question for you yourself. I mean, the markets don't have an impact on what the Fed does. They're not supposed to, at least.
Not supposed to, but
the Fed is looking at the economy. They don't really, they telegraph that they don't care about what the market's doing. It's completely independent. So, yeah, the market's at all-time highs, but if they see the consumer weakening, if they see labor
bombing in Gaza or bombing in Qatar today, I mean, geez.
Oh, I'm gonna abstain.
Well, I'm just saying, like, there's just a lot of things going on around the world, including rate cuts and Bank of England, rate cuts in Europe, and everybody's like, oh my God, we got to cut rates like Bank of England and Europe. It's like, really? Or the ECB? Like, you want to follow those economies? Like, just into the well? Great. Let's do that. Let's just keep cutting rates like those guys do, and also banging out our dollar too, which is getting smashed around the world because nobody wants it all of a sudden. Yet we want to raise debt to fund all our spending, yet nobody wants the dollars in which we pay them for the interest on the debt they lend us. I mean, it's a joke. Everything's mixed up right now, and so I think there's a lot of things economically that will work themselves out in the next few months, thanks to you, and thanks to this podcast.
I agree.
Probably.
You've got a lot of signals signaling different things. What the Fed looks at is labor and inflation.
Fair.
So talking about the market, as we just kind of led into, the last month we've had tech pullback. We've covered that a little bit. You have equal weight S&P actually outperforming the cap weighted S&P over the last month. Question for you is what really constitutes a rotation for you? Because all the time, the market trades 5 days a week, every single week. So there's going to be periods of outperformance for different sectors. Tech is going to skyrocket for a year and then pull back. What constitutes a real rotation that investors should actually pay attention to? Is it a month? Is it 6 months? Is it a year? Is it 2 days? Does it depend?
It depends on what rotation means to you, frankly, or to our favorite cheerleaders and Monday morning quarterbacks, Tuesday morning as it were today, of like the CNBCs, Foxes, the Bloomberg, all you guys.
Anytime you see red, it's a rotation.
We love you. Yeah, it's
right?
rotation.
Red's a rotation.
This is over. And then the new one's coming, and then they're like, oh, wait, we're going back to the other show where we said this was just a fake out. I think, Jake, it's faster now. I think the rotations are obviously much faster than they were when I was growing up, when I was your age. It was like these rotations were slower. I mean, talking about 6 to maybe 8 months on some of these, from especially cap to cap, like small to mid to large, and then certainly among sectors, which weren't as big of a thing back then. And that's a complete dating of myself, but it's true. And then nowadays, as we have the proliferation of ETFs and companies that have gone into sector-based weightings too, it's like I think that rotation could be like 3 months, man. It's a little bit around a corner, but like depending on too, like look at these commodity prices and look at some of the things that have happened in crypto. Like those rotations, man, last, I don't know, 12 hours, 36 hours, about as long as you do.
Quicker. Yeah. Crypto's still quicker movements than everything else.
It
and
is.
Gold is still at all-time highs, which is pretty incredible.
Which is why, though, to your point, it's a great one you asked, though, is like that's why we continue to focus on fundamentals.
Yep.
That's why we continue to focus on long-term data points that both focus on the near term because they have near-term influences, but long-term show us the path. And we try not to get off of that path too often because if you step off the path, you got to step back on at some point and back and on. And it just gets into this crazy frenzy of like, over the course of time, you don't usually win out over that course of period because you just end up making the wrong mistake at the wrong time. And that costs you all the work that you put into that point versus walking straight and keeping that pace.
Yeah, so on your topic of portfolio construction and kind of piecing that together, I was interested in your take, and we talked about this at the investment committee meeting that we had a couple weeks ago, but stocks and bonds mixing together. I looked at some correlation data. Over the last 5 years, the correlation between the AG and the SPY is 0.192, which is not a lot to write home about. But the 15-year correlation is basically zero. It's spot 0.25. Is that tick up of 20% or so?
Yeah, correlation.
Is that meaningful, or is that, as one of our friends in the investment committee said, Spurrier's correlation just kind of random? Because everybody talks about 2022 and how you didn't get protection from bonds, and what's the point of being in bonds if you weren't going to be protected? So is that really carrying a lot of this correlation data, or is there a serious breakdown that is from here on? Something maybe that happened in COVID, is AI, whatever
it's
it might
COVID.
be.
Trump, I think Trump administration part one was affecting that too because rates were kind of up and down, and then he was trying to push rates down then when the economy was blowing up. So you're right. I think the correlation numbers are something to look at. It's why that has led to proliferation of other asset classes like the Bitcoins of the world and some of the international stuff we've seen happen and pop up from credit and whatnot. And I think that's too why bonds still have a value, but I don't think the value is as say dependable as it used to be. I mean, I think back in the day, you knew what you're going to get with bonds. You actually get a negative correlation in some years, which was awesome. Right. I mean, you have a crazy S&P and you get a bond.
You would say the 60-40 is dead.
I think the 60-40 as of right now, as we used to know it. Your father's 60-40 or your sister's?
Yeah.
Not your sisters, whoever, but like it's somebody in your family. Their 60-40 is not going to be the same 60-40 that they would do now. And I think that's okay because we have found other asset classes. Right. We found other strategies that I frequently like better just because of the fact that I get kind of bored with the stock and bond thing. I mean, as investment advisors, as client protectors, as big wealth guys, it's like you really want to just be like, hey, here's your AG and here's your SPY.
Right.
Boring.
What do you need me for then?
You don't need me. Jake, get out of here.
Yeah, exactly. So let's move into the retail investor spotlight. This week's topic, I want to talk about credit and the consumer, right? We're starting to see, in my opinion at least, a little crack in consumer strength. We talk about this a lot where it really just matters what the upper 20, maybe even 10% is doing. But the credit card delinquency rate is up. And you might initially take that headline and say, okay, well, it's just based in the bottom 80% of consumers or whatever you want to call it. The credit card delinquency rate is up amongst all demographics of income. So whether that be low income, in poverty, upper 10%, 1%, all of them are higher than they were a year ago and higher than they were 5 years ago. What do you make of that trend?
Nothing. It's just more credit being extended. I really think it's a numbers game.
But it's delinquency. It's not open credit.
No, but right, there's still credit though that went up that they're not in delinquency. But like it's one of those things where you have a situation where there are more delinquency rates, there's more defaults, there's more foreclosures. Fine, but that's also because the market itself is bigger. It's just like when we have the weather stuff. We talk about weather a lot as I try to every day, and it's like nobody wants to listen. But it's like there's a reason that more natural disasters are happening, more things are getting screwed up, like money-wise, because more people are living in areas where it's fun to live because the markets or the weather is nice and bold and big and strong. So there's just areas where you're concentrating things that tend to be data inflictive or data effective that really are not telling the whole story. Because you're right, I think it's not great to have delinquencies up across the board, but the delinquencies that are up in the top end of that echelon of that spender, was 20% or 10%, aren't near as unbeneficial as the credit people that are in there that are new there that are still in good credit. You know what I mean? Because there's some delinquencies that are up there, but you want the big growers anyway.
Right.
They can outgrow the delinquencies, is my point. And that's the way that's again, I mean, dare I say, that's why credit extended to the right consumer, the right borrower, is positively sloped investment. Because it's the right thing to do over the course of time because it begets more strength in spending and it begets more job creation. And that's why I think the credit card markets are, again, needing to be, as you pointed out, because you listen to the podcast obviously very well, they need to be focused on where the spenders are. Where's the profitability? It's at the top echelon. And as long as those guys are doing okay, same with the taxpayers, everything's going to be all right.
Yeah, I mean, I think it goes back to a point you made last show where you said if a couple or a person can't afford a house at a 7% mortgage rate, they're probably not the right person at 6%, right? That 1% on a house, if you can't afford the 7, maybe you can afford 6, but just barely. That's not the right person that you want to be
even you wouldn't think that's a good investment as a consumer.
Which?
That one.
The person that can't afford 7,
you wouldn't say that. I mean,
6.
Too many people are out there like, I just need rates at 5% to get this thing, this Ferrari. And it's like, really? what are they at now? Oh, like 5.7.
Yeah.
And I'm like, okay, like you sound like you're pretty stabilized when it comes to your like payments and your budgeting. It's just to me that's like a fool's paradise because those are actually, thank you, Mr. and Mrs. Economy, or thank you, Mr. and Mrs. Fed. Sorry, President Trump. It's like, thanks for keeping those people out of the market right now. Because if they were in the market now, borrowing things when the economy is maybe slowing, to your point, at least job-wise, this would be a problem. Yeah. You want another credit card or credit problem on your doorstep? Let's keep lowering rates to make sure more people get into credit that don't deserve to. That'd be great.
Yeah. So as you mentioned, as financial advisors, as investment people, as wealth people,
humans.
We as humans, we've got hundreds of clients across the country. You obviously maintain your own practice. Is this a conversation that is A, at the forefront, or B, you're ever having with clients about credit cards and delinquencies and, maybe we need to raise cash to pay off some debt that you have? Is this something that you're experiencing in conversations? Because it really depends on, for me at least, it depends on where in the country the financial advisor, our client is. For whether or not that this topic comes up.
What's their income outlook too? I mean, what's the structure of the debt look like vis-a-vis what's their income outlook vis-a-vis when they're going to need maybe more money out of their portfolios? And then what we do is structure a debt kind of payoff program, is what we call a DPP, I believe. And Diamond Dallas Page, WCW, back in the day, 1990. The Diamond Cutter. Again. So yes, that was just yesterday. But it's also thinking about that consumer, that client who needs help with their debt structuring to the degree of how it fits into their lifestyle. And you just said it. It's like some people have different reasons and different rights to structure off different parts of credit and different ways to refi. But the help on the front end is making sure clients are most believably comfortable with their debt structure, comfortable with the rates. And if they are, when it fits into their lifestyle, that's not a bad thing. I think that's great, provided that you can grow out of debt and eventually pay it back in theory, or just stick it to the person who lent it to you, either one.
I think a trend that will make its way into the financial advisory space that's probably not there now is buy now, pay later. And these apps, Affirm, Klarna, et cetera, that are mostly used, I would say, by Gen Z and millennials. And you see tickets being paid for on buy now, pay later.
Oh my God,
so
that's
people
great.
People are buying $400 tickets,
parking tickets,
and paying 12 months of
parking tickets,
concert tickets,
tickets. Okay, Met
whatever.
Tickets, Bears tickets.
When those people get the transfer of money from Gen X, I think that's going to be something that really impacts. And FICO's actually incling those buy now, pay later debts into
Good for
credit
them.
scores now.
Good
as of
them.
like this
That's
month.
going to do amazing things for your credit score. And Jake, I mean, I got to ask you, of your demographic, are folks using your friends and family and whatever using the buy now, pay later at all?
Yeah, I think so.
Are you?
I think there are people. I think it's actually younger than me that uses it all the time. I know
all the time.
My brother's in college. Yeah, they use it. I mean, literally because when somebody that's not super educated in the space sees I could either pay $100 now or I could pay 10 payments of $10 over the next 10 months, sure, I'll pay 10 now. And
That's
10.
cool.
And so I think that's a small example, right? $100, but those people are going to grow
example.
into the income generators.
Absolutely.
And then that is going to become bigger and bigger purchases.
And you get 100,000 of those people, you got some real money there. Yeah. I look at those buy now, pay laters when I'm not terribly stressed to buy off. I don't know whatever you want to call it, that date with Taylor Swift, or the chance I had to have a cup of coffee with her and Travis Kelce. It was like, I don't know, it was like $100,000. It seemed like a great deal for like 10 minutes. Anyway, like you pay that off. I see it and I was like, I don't want to pay it off because I don't want to like do it on a layaway type of thing because it just doesn't feel right. Whereas like for folks like you or in your demo, it feels right. It's like it's a typical thing. So you guys actually get some practice in budgeting and staying on point with stuff like that and those obligations, which I think actually might be a good thing. For somebody like me, I don't want like weird debt like that. I just want to put on the credit card and pay it off monthly and not have this like 10 by 10 by 10 thing.
Right.
But that's cool that your demo is starting to really grasp onto that one way or another, because maybe that is the future, and that's kind of old me sticking to like my old ways of doing it, and that may not be the way the economy grows going forward, which is fine.
Yeah, I mean, we'll see. I think providing people new ways to build debt is probably not
and as long
a good
as they
thing,
pay it
but
back,
we'll
but as long as they pay it back and service the debt, that's what debt does. Eventually, like I said, you either die with the debt or you maybe get a chance to grow yourself out of it. So that's the structure.
Scott, let's move on to fade or trade.
Okay.
So we've got 5 fades or trades today. We're going to switch off who poses the question.
You've got to get the first. You start with the first one because you usually lead this off so well and get me so angry.
That's the goal.
And you really calm me down on this podcast, so please start.
All right, first fade or trade of the day, Scott. The Fed's independence will be revoked by the end of Trump's presidency.
Revoked. I mean, I don't revoked. Rejoked. It is a joke. And I think we talked about this last time. We're talking about the emasculation of the Fed, the deconstruction of the Fed, the basically embarrassment of the Fed, where I believe that once they get that new thing built in D.C., which is like a club on top of like a hotel,
the Fed's
like
edition?
a grocery store. Yeah, it's like there's all kinds of cool stuff in there. I've heard maybe a live music concert. They have like a lot of things going on at the Fed both now and wait until next year when Powell's out of there and they're changing over some of the governorship and maybe they screw up this rate cut, which I think is happening maybe soon. I think it takes the Fed really into a tough position where I think they're going to be like, yeah, see ya, bye, send them into space.
Did he fade or trade that?
Oh, I'm fading the fact that they're going to be any kind of relevant the way they used to be relevant going forward.
Okay. I am fading that the Fed is going to lose their independence by the end of the term. I think
fading.
I'm fading it.
Wow.
I don't think they will. I think it'll be in front of our eyes and ears every single week and every month until President Trump's out of office. I think Powell, as we've discussed, will get replaced. I know Stephen Moran. What I heard last week actually was that his term is obviously up in February, but until Trump nominates a new official, he just sits there.
Yep.
So you're going to.
And he's not going to nominate somebody new to. Yeah.
Why would he nominate someone? So I think it's going to be something that we hear about every other day and every week and every month, and we're going to see it on Truth Social and Twitter or X, whatever. But I don't think any grandiose changes will be made.
I think the Earth is always moving. It's already moving on that, so it's going to come to my side. But here's one that's maybe something right up your alley. The consumer, i.e. you, is getting weaker and weaker, and it's a potential warning sign for the economy, Jake, or as far as a recession happening. Is that a fade or a trade situation? We haven't talked about the consumer or the economy very much today.
No, not at all.
Yeah.
You're going to hate this. I'm trading that. I'm trading that the consumer is weakening, and it may be a potential warning sign for the economy. I think the flashing red lights are there. We've got the consumer weakening. We've got the job market, and the labor market is really weak. I mean, the revisions are just are horrible that we're seeing. The 911,000, a little bit of a headline because 12-month revisions are literally always negative. They've been negative every year since 2019 besides 22, which is just, a market coming out of COVID in 21. But still, I think that the signs are there for a recession. I get your point about GDP growth. We'll see how that actually plays out in Q4, but I think it's another factor that leads to possibly the R word.
Wow, the recession word or the rebuttal. We're going to say rebuttal. My
rebuttal. I'm not worried about your rebuttal.
My rebuttal to that is I dare you to just short the consumer here. I think we're coming into a good period of some growth. I think the AI stuff's going to help with the economy get less pressured and less freaked out. But then again, consumer weakening on a broad scale, especially at the high end, is something to look for, especially in previously strong areas of that high end consumer.
So I think that was a fade.
Fading
you.
you.
Need to start
I'm
with
going to fade.
Fading or
I'm going to fade you. Okay, on that. I'm going to fade your
Okay.
idea because I'm assuming it's traded. I think the consumer's better.
Okay.
So maybe that is a fade. I don't.
That's a fade.
It's a new. Okay.
Third fader trade, Scott. This one hurts, but I told you I'm going to be very biased about the Bears on this episode. The Packers are the best team in the NFL and the team to beat this year. Fading or trading that?
It's been one game, and it was how much would they play? 60 minutes? I mean, come on, dude.
60 minutes.
And how much did Micah Parsons play? He looks like a doofus out there. Listen, I don't think Jordan Love is that good. I think the Packer receivers know how to step up. Golden was basically independent and invisible. Christian Watson's another guy that came on in the Packers. Was supposed to be so good. Romeo Doubs stinks. The running back, I mean, Josh Jacobs, I like Josh Jacobs. I think they got a pretty tough kind of defensive line too. But, the Packers aren't exactly what everybody's going to cook them up to be because they showed well against the Detroit Lions team. They came in a tough position. I mean, that was a tough spot. 4 o'clock game on the East Coast. And it was just a game where everybody was just pumped up about the Packers. Those are games in the NFL that just show well for the home team. So I'm going to fade that. There you go. To actually stick to the prod here, I'm going to fade that and say it's not the Packers. I think it's your typical, I think it's your Bills and Ravens and those guys, and maybe still the Eagles and Redskins.
So for the first time today, I'm in agreement with you. I'm also fading that. I had the same teams written down. I said earlier on the pod, I think it was the most complete game a team played, but I completely agree with you on the situational spot for the Lions. 2 new coordinators, they're going to Lambeau. There's all the hype about the Packers. They just got Micah Parsons, who played 40 snaps.
Looked great out there.
I still think you can't leave out the Bills. The Ravens loss doesn't do anything to me
True.
in terms of shaking up
Those guys
whether
are
I
good
think
teams.
they're good or not.
Yeah.
The Bills, Ravens, the Eagles, I think are still the teams to beat. The Packers, I think, will be there, but we'll see. I don't think I'm in agreement with you. I don't think Jordan Love is that special.
He's not. I think it's going to be a fun year. And so staying on that fun kind of assortment of teams, I'm going to say this. Fade or trade, Jake. The Dolphins, your favorite animal, are the worst team in the NFL.
They are my spirit animal, and I'm absolutely trading that.
I said favorite animal. You have another spirit animal,
That's
don't you?
my spirit animal.
The gargoyle?
I don't even know what a gargoyle is. But,
yes, you do.
I'm trading
Gremlin.
that. I don't think it's a necessarily hot take. They were a dumpster fire all training camp. Tyreek Hill's obviously pretty upset. The defense sucks. Tua should probably be out of a job. Mike McDaniel might be gone by week 4 or 5. I think the only way this doesn't happen is if the Saints are worse. So I don't think it's anything the Dolphins can do. I think the Dolphins are really bad. I think the Saints could be worse. I'm surprised that Kellen Moore had Spencer Rattler throwing 46 times on Sunday.
God, he's terrible.
That
Spencer
cannot
Rattler
be the game
sucks.
plan. So I'm trading it. I think the Dolphins are the worst team in the NFL.
I think you're right, and I think it's Dolphins Saints, but I don't think one basically derives the other here because I think they both can be really bad. I think both teams have a chance to lose basically all games of the year, especially with the turnover that's going to happen with both on the team and in the management or in the coaching side. Next one for you, Jake. Go ahead, take it.
Last fader trade of the day before we get to one number to watch to wrap up. The Apple iPhone 17 series that is being launched this week and announced this week will disappoint again. Are you fading or trading that?
I mean, I've been disappointed with Apple since basically iPhone 4. So for me, that's a kind of a rhetorical question. It'll probably disappoint again, although Apple's destroying my faith and just my encouragement of them so much that eventually I'm going to be impressed. They've just basically torn me down. So
fair.
I think it'll disappoint again, absolutely. And if people still think that Apple's going to come out and wow them because Siri is so good and she's sucked for 6+ years and been thought she's my girlfriend and she's not even really talking to me anymore and doesn't understand anything. I ask her when she doesn't understand. I say, Siri, why don't you understand that? I don't understand how to reply to that. I'm like, yeah, exactly my point. You don't even realize what conversation is. You have ChatGPT and all those guys figured out. So, yeah, they're going to disappoint. Absolutely. I'll trade that all day long and twice on Thursday.
Again, I'm in agreement. I'm going to trade that Apple iPhone 17 series. Is going to disappoint again. I think Siri probably can't understand you. You might talk a little fast and a little far from the phone.
I speak different to her.
We'll leave
okay?
that out
She gets a special
out of the picture here. Agreed with you that iPhones have underwhelmed for years. The Apple Intelligence people think is way behind.
Really bad.
The
really
hardware's
bad.
behind. You mentioned ChatGPT. OpenAI is light years ahead of Siri. I even think there's a lot of consumer fatigue with having every new iPhone you get, you got to buy different AirPods, a different charger, different accessories.
Crazy.
And it's bothersome. It's annoying. When the new iPhone comes out, your iPhone 15 dies quicker. It's ridiculous. I think there's some fatigue there, and really the only reason people continue to own iPhones is the blue text messages. I think the green text, you always have that one friend and you're like, dude, you're ruining the group chat. So blue looks good, but that's really the only reason to keep iPhones.
I got something for you, man. I will, and I want to throw away my number too, but real quick on the iPhones, man. I think by the end of the year, if this podcast continues to get any airplay whatsoever, which is obviously not showing like it's gonna, but I think we do an iPhone switch.
Yeah.
I'm done with the iPhone. I would love to get a new phone. I have something else than this thing. This thing I'm holding up right here that's already cracked and stuff.
I'd
So
love
it
to
came
see
cracked.
it.
I didn't break it. Whoops.
Well,
and it's like there's a there's a
his
whole.
phone
I
off
didn't
the
mean that.
countertop?
I meant to just push it to the edge. There's gonna be a new phone I think out there, something new that might be good that we should try to check out. Maybe actually jump to. I'm honestly saying that. I'm sick of it. My number really quick, Jake. 2500. That's NASDAQ level. I'm thinking about 25,000 basically on the NASDAQ now. So we're going to say 25,000, which is the next level, I believe, for the NASDAQ composite index, which is effectively all your tech stocks in the economy. And right now we're pushing about just a little bit over 2380. So you're looking at another, so? Which I think is easily going to be accountable. And that 25K is going to be a big, big number for just kind of the overall markets, the economy, Trump speeches, things like that. That'll just be great to see for the economy as we kind of progress into this next level of kind of growth and future economic development.
Great. My one number to watch, and I was going to do a callback to my last one number to watch, but it was in, the Bears lost, but I did have Roma Dunze scoring a touchdown.
Garbage
wasn't
time.
dancing in the end zone because it was garbage.
He wasn't dancing. Justin Jefferson was, though, a couple times.
He was grittying. My one number to watch this week is we have another.
Didn't you give us one?
No, we've got another pod next week that we'll be able to identify this on. But my one number to watch for this week is 4%. I think that the Fed cutting on Tuesday, if we get a jumbo cut of 50 basis points, could take the Fed funds rate down from 4.50 to 4. I think it'll be 25 bips, but keep an eye out for a jumbo cut. I think that would send the markets into a little bit of a frenzy. I don't think that would go well for the markets. I'm looking for 25, 25, 25, something orderly, not a big 50.
Jake,
cut.
You sound like you're petitioning for the Fed chairmanship. And then also, let's notice something. What happened on Friday besides that jobs number that was really, really weak and terrible that should have just paved the way, sent the lead block, which the Bears didn't really run much fullback positioning yesterday, sent the lead block through the line of scrimmage with the fullback, the Vikings did, and run that running back up the middle, meaning what did the jobs number do for that on Friday, that last Friday? The jobs number came out was stinky.
Yep.
It gave this lead block for the Fed to come in and do the whole cutting, the whole planned cutting, whether it's the first 50 cuts, whatever it is. They were all set up. They're all going to be there. The market went down. The market sold off basically the whole day. Yeah. Rates went down too, but guess what? People sold off equities because they're like, gee.
It wasn't a big move, though.
Yeah, but that's a pretty big move on what was the number that was the clincher. I don't think that's really a great sign either. I think it's one of those situations where if the market starts realizing the Fed's cutting, and that's not really bringing on this new great consumer borrower, not changing whatever the effects of the bad economy is that many of you talk about out there, it's like if that doesn't change anything, then people are going to start freaking out, and they should. And that's why these rate cuts shouldn't happen.
Well, they will. We're going to see it next Tuesday, so then we'll have to go from there.
See you next Tuesday, and it's Wednesday, actually, but thanks.
Yeah. So that's our show for today. We've got an episode next week live from the Kingsview Summit. We'll have a couple guests on, probably a shorter show as we'll be on stage and on panels.
Don't
for
talk
most
as
of
much.
A 2-day segment. I'll try not to talk as much. It's hard. But we'll be with you the next couple weeks as well, and that's the show for today.
Kingsview Wealth Management is an investment advisor registered with the SEC. Registration does not constitute an endorsement of the firm by the SEC, nor does it indicate that Kingsview has attained a particular level of skill or ability. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. All opinions expressed by the positively sloped participants are solely their opinions and do not reflect the opinions of Kingsview Wealth Management, its parent company, or any of its affiliates. You should not treat any opinion expressed on this podcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information the positively sloped participants deem reliable. Kingsview Wealth Management serves as portfolio manager to separately managed account strategies and investment advisor to exchange-traded funds. As of the date of this recording, those strategies and funds held positions in Nvidia and Microsoft and did not hold positions in Apple or Google.